हाय फ्रेंड्स, दिस इज़ ये हर्षित अग्रवाल। होप आप सब अच्छे होंगे, मैं भी अच्छा हूँ। सो टुडे विल डिस्कस अ टॉपिक दैट इज़ रिलेटेड टू ऑडिटिंग एंड इट्स वेरी प्रीवेलेंट एंड इट्स वेरी important and it's very common thing in auditing, that is audit assertions. Yes, you heard it right. We will discuss about what are assertions basically, what are important assertions pertaining to balance sheet, and what are the important assertions pertaining to profit and loss account. So straight away going into the topic is, what are assertions or audit assertions? Basically assertions refers to the representations by the management. Basically they are making some assertions or basically explicit or implicit claims about the about the elements embodied in the financial statements as being used by the auditor to consider the different type of potential misstatements that may occur in the financial statements. In the preparation of financial statements, companies management who is accountable or who are being directly involved in the preparation of financial statements makes various implicit or explicit claims, that is assertions, regarding completeness, accuracy, cutoff, existence, valuation, right and obligations, and presentation and disclosure. I repeat it: completeness, cut off, existence or occurrence. You can see either one. Valuation or measurement. Anyone can be okay. Rights and obligations, presentations and disclosure. I have made an acronym of it to remember it as a short form for CCE PVR. CCE PVR. C stands for completeness, C for cutoff, E for existence, P for presentation and disclosure, V for valuation, R for right and obligations. What are they reflect or resembles? These resembles of assets, of liabilities, equity, income, expenses, and disclosures in accordance with the applicable accounting standards or Ind AS. It basically, these assertions which we have talked about represent, obviously they will represent for some FSLI na. So these FSLI are categorized into what? Assets, liabilities, income, expenses. That is what I'm talking about. And example of assertions what I have noted is that one example I can share with you is that uh, just like that, if there is a company X, okay, if company's X balance sheet shows a building with the carrying amount of INR 50 lakhs rupees, auditor shall assume that the management has asserted or claimed that building is recognized in the balance sheet is existing as at the period end. Obviously that particular building is physical asset, so they it has to be existing at a particular location or anything. So this is existence assertion that management is given assurance to the auditor. And companies X owns and controls such building, that is the ownership and controllership of that particular building is in the custody of organization. So that pertains, that assertion is rights and obligation assertion. So we have seen for the existence of the building, we have seen for the rights and obligations assertions of the building. Then building has been valued accurately in accordance with the measurement principles followed by the organizations, be it for the accounting standards or be it for the Ind AS. So that categorization has followed for valuation assertion. Then we have all buildings owned and controlled by company X are included within the carrying amount of 50 lakh rupees. So that is a completeness assertions. It might be possible that out of 50 lakh, sorry, within 50 lakh rupees, there can be 5 lakh, 10 lakhs, and other amounts which are pertaining to different valuation of the building, and different small amounts which are included in 50 lakh rupees. So that is completeness assertion we are talking about. Now we will straight away go on to the income statement assertions, uh, which I have told that assertions pertains to income statement and the balance sheet. So first we are talking about income statement assertions. So what income statement assertions comprises of? First is occurrence. Occurrence Occurrence basically defines basically what it reflects. It's that transactions which are recognized in the financial statements have occurred and relates to that particular entity, which defines that that transactions or whatever FSLI items which you are recording in the PNL have actually been occurred or not. For example, we can say for employee benefit expense, if we are recording employee benefit expenses which has been incurred during the period in which the personnel or the employees has been employed by the entity. Another thing can be that employee benefit expense, I am talking about expense related assertion, and if it is income related, then we can say that recorded sales which are in the P&L statement of the organization represents goods ordered, dispatched, invoiced in the period correct period or not. So first is occurrence, second assertion is completeness. Completeness means that all the transactions which were supposed to be recorded have been recognized in the particular financial statements or not. Transactions haven't been omitted intentionally or by mistakenly by the organization or not. So all the transactions ought to have been recorded in the financial statements. Example, that employee benefit expenses which we are talking about, employee benefit expenses in respect of personnel have been fully accounted for in the particular financial statements, or all the genuine sales has been recorded if income side is concerned. Next assertions pertaining to balance income statement is third number is cut off. Cut off comprises that whether all the income and expenses are being reported in the correct accounting period or not. Mind it, all the income and expenses are being reported in the correct accounting period or not. That if we are following the cutoff as 31st December or 31st March, so it comprises that all the income or expenses pertaining to that particular cutoff has been considered while the preparation of financial statements by the organization or not. Okay. And example, we can say that for employee benefit expenses recognized during the period related to the correct accounting period or not, or if sales are concerned, then sales include the dispatch of goods made at the year end at the relevant period, which comprises basically we have to consider the goods in transit or where the goods has been returned by the particular vendor or particular customer or not. Then we have measurement. Fourth number assertion is measurement. Transactions has been recorded accurately at their appropriate amount in the financial statement or not. So we have to categorically understand that measurement is also a very important assertion, that obviously the transactions which are recorded have been measured accurately or not in the correct financial period. For example, employee benefit expenses has been measured or calculated accurately, or any adjustments pertaining to that might be income tax, might